Well, it's crystal clear from the data that we have, everybody's talking about it. And as you mentioned, Ted has been on this for a lot longer than you, me, or everybody else.
Mm-hmm.
But the COMEX inventories are being drained not only physically, being shipped out the door, but we're also seeing, as you mentioned, a shift from the registered category and back into eligible, which means basically that it's being moved into long-term storage where the people who own it have no interest in selling it at this time. So the drain is not only physically out of the COMEX, but it's also, like I said, going from registered to eligible. We're seeing that in withdrawals from SLV and conversion of shares. We're seeing that the LBMA, the retail bullion market is on fire. The wholesale good delivery bar market is the demand is just absolutely astronomical, no matter where you care to look. And of course, that obviously showing up in depleted inventories. And all we need now is a price to match that fact, which we don't have.
That's been the subject that I've probably talked about on our program more than any other over the last few years, is the fact that you have this derivative market in which people will come and bet on essentially they're betting on the spot price of silver, and they're taking a position either with a future, an option, or gold into some point in the future, usually 3 to 5 months. You can go longer on the futures if you want, but usually it's, there's 6 delivery months a year, big ones, and they'll work those delivery months. So we have that action, which determines the spot price. And if you want to add in what goes on in London OTC as well. And then there's what's going on physically with either the very few contracts that settle physically on COMEX, or the retail market, or the fact that now some companies are coming out and buying directly from mines. There is a disconnect between the physical and the paper market. And Ed, why does that exist? Why do we have such a big disconnect on what the spot price is and what the physical trade is actually telling us about gold and silver?
Well, as you mentioned, the price of all major commodities is set in the COMEX futures market. And, as Ted has pointed out many times in the past, the COMEX, the NYMEX, and the CME group are basically criminal organizations that allow these price management schemes to continue, not just in silver and gold, but the other precious metals and a few other commodities as well. Ted says it's been going on for at least 40 years in the COMEX futures market. I'd say it's more like 50, but I know what's 10 years between friends,
Yeah.
But the fact of the matter is that 4 or 5 or a handful of traders, the largest 8 traders, Ted says, they've been controlling which are all major bullion banks or investment houses, have been controlling the price of precious metals and other commodities now for several generations. And they set the price, and it doesn't make any difference what supply and demand is at all. It only matters what's being traded in the COMEX futures market, and that alone determines the price, which is criminal, because that's not the way it's supposed to be at all. But if you're looking for a reason why the price of gold, silver, platinum, palladium, and copper and crude oil and probably other commodities are where they are right now today, it's because it's being set by a handful of traders doing it illegally in the COMEX futures market.
Yeah, and two pieces of information to help us understand the big players. So if you look at the CFTC Commitment of Traders report, it'll give you a clue that the bullion banks are the ones that hold the big shorts. And if you dive down that information, that or if you look at Nick Laird's site, Gold Charts R Us, you'll know that there are 4 and 8 big banks which control that. I also found this year the Office of the Comptroller of the Currency report on derivatives breaks down who the 4 big banks are in gold and silver, and it's Bank of America, Citigroup, Goldman Sachs, and JP Morgan, according to the OCC. So those guys, not only are they some of the biggest participants and basically the market makers in the U.S. gold and silver market, but they're big players in all the derivative markets. When you see something like that, Ed, has it ever occurred to you why 4 banks would want to have so much control organizationally over all these derivative markets? Is it just to profit from trade, or there are other things there? I mean, what have you found over the years? Why this concentration in just these big banks?
Well, there certainly is a profit motive in there. However, my opinion is that they're in there to basically keep everything paper propped up and keep everything physical suppressed, so people don't go running from the paper asset side of the street to the physical asset side of the street, which is what they're showing signs of doing now. But this has been going. This has been this has been their policy now for 40 or 50 years, and it goes back probably even further than that to when we went off the gold exchange standard in 1971. And as far as these bullion banks are concerned, there's like 5 or 6 or 7, like you said, plus a couple of investment houses. And as you mentioned the fact market makers, and as Ted correctly pointed out, who died and appointed them as market makers in all these commodities? They're controlling them for a specific reason, and that's the price. And like I said, it's criminal from one end to the other. But as Ted has been commenting on for the last since the LME nickel thing blew up in London on March the 8th, the big shorts in the COMEX futures market in the precious metals have been moving heaven and earth to get out of their short positions, and that's been going on right up until last Friday. And right now they're the least short they've ever been. So hopefully this thing is going to come to an end sooner rather than later, but we're all still waiting for that day.